Well, there's a lot of progress that's been made since Glasgow, but we're still moving in the wrong direction. So many of the reports from all the agencies tell you that in order to keep the world at 1.5 degrees, we need to reduce carbon emissions by 40+% by 2030. When you look at one segment of the world, which is the listed companies of the world, and you put them all together, 99% of the market cap of the world, those companies are going in the opposite direction. In the last 12 months, they've increased carbon emissions by 11%. So this year, they're projected to emit carbon around 12.5 billion metric tons. So if you think the world emits 50 to 55 billion metric tons, that's a big part of the world, and they're going in the opposite direction.
So let me get this right, and we've got other numbers, I know, because we've both been looking at them as well. Of all the companies in the MSCI World Index, we're talking about the majority of companies are nowhere near aligning their pathway to 1.5 degrees C or limiting their contribution to the world to those kind of figures.
Yeah, and again, it's some progress, and that we could pat ourselves on the back, but the question is, how far are we from the goal? So if you look at all those companies in the MSCI AQMI, the All Country World Index, is about 9,300 companies. Yeah. If you look at all those companies, only a quarter of them have plans that are consistent with a 1.5 degree world. Everyone else is 2, 3, 4, 5 degree worlds.
So, I mean, if it's the wrong question or not, but who's to blame for that? Is it the investors by not pushing their boards to that, or is it because despite all the talk that you, I, others had about stakeholders, it's still just about shareholder returns? Is that the problem?
Well, I think that that's the key question, for sure, because people are going to react to what the providers of capital are asking them to do. And the providers of capital is the global investment industry, global finance, global insurance, right? So our job is to go to the providers of capital, like pension funds, and say, you got to reprice and reallocate your capital consistent with the climate risk and opportunities that are coming your way. And therefore, once they start doing that, right, the asset owners, the asset managers will need to run money on the basis of that, because the benchmark will reflect that, and then the companies will begin to change their behavior.
But are those owners, those owners of trillion-dollar pension funds, are they moving in the opposite? I mean, BlackRocks, the Vanguards, the big pension companies, what we're saying, that they don't care as much as they did a couple of years ago?
No, they do care, and they do care.
So
and
those
are the managers.
Why are they voting down more ESG maneuvers than ever?
Those are the managers. Remember, the owners are the pension funds, the endowments, foundations, and all of that, and then they give assets to the managers to manage. But they're going to give the assets to the managers compared to a benchmark. And if the benchmark has nothing to do with climate risk, then they're going to behave according to what the benchmark says. So what we're trying to do is change the behavior of the asset owners by providing them with different benchmarks that incorporate the climate risk and opportunities in the world today, and then they begin to change their asset allocation, and therefore managers begin to change the way they asset.
And this is where it gets really interesting, because on the basis of the new metrics you're talking about, does that mean a vast amount of public equity is mispriced?
100% mispriced. Totally mispriced. Private equities are mispriced, private debt is mispriced, especially private credit. The private asset classes are mispriced. Now, how much mispriced, we don't know yet, because there is still early days of the quantitative models and the data associated with analyzing this.
But I thought we had the data. I thought you and I did this 2 years ago. I thought we had the data in place to say, so that we could measure accurately the process towards these companies getting on track.
Well, we have data for many of the listed companies. We are beginning to have data for the private companies, right, and data for the public fixed income, the securities. But we at MSCI already have carbon emission estimates for 70,000 issuers, public companies and other bond issuers and the like. We have what is called implied temperature rise metrics, which is a measure of direction, projection on that. But a lot of that still needs to be factored into a risk model and an asset pricing model.
Right.
See, we have the data, but the data is just the foundation. Then you have to put it through the risk models and the valuation models to understand the mispricing that exists today.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.